Okay, so you want to own the company behind GTA 6. You walk into a studio where hundreds of developers are building the most anticipated open world in gaming. You approve the final trailer. You decide when the game launches. At midnight, millions of players press the same download button, and before the weekend is over, a river of money begins flowing through your company. Every copy sold belongs to you. Every premium edition belongs to you. Every player who buys virtual currency, joins a membership, or spends another 5 years inside the online world becomes part of your business. And unlike a restaurant, an airline, or a ranch, your product does not need to be manufactured one unit at a time. Once the game exists, another digital copy can be delivered almost instantly. No warehouse. No shipping container. No shelf space. Just a button, a payment, and another customer entering a world your company owns. That is the fantasy. Here is the first problem. There is no independent company called GTA 6 that you can buy. Rockstar Games develops and publishes Grand Theft Auto, but Rockstar is a wholly owned label of another public company called Take-Two Interactive. And Take-Two does not only own Rockstar. It also operates through 2K and Zynga, with businesses stretching from NBA 2K and Borderlands to mobile games such as Toon Blast and Words with Friends. So, if you want full control of the company behind GTA 6, you are not buying one studio and one game. You are buying an international entertainment group with nearly 13,000 employees, billions of dollars in annual revenue, billions more committed to unreleased games, and a market value that moves whenever a release date changes. The second problem is even more important. Owning the company behind GTA 6 is not really a bet on whether GTA 6 sells a lot of copies. Almost everyone expects it to sell a lot of copies. It is a bet on whether one enormous launch can become a durable financial system that keeps players spending for another decade. Because the game creates the event. The online world creates the annuity. And by the end of this, you will understand why the most valuable part of GTA May 6th not be the game people buy on launch day. It may be the permission it gives its owner to monetize the same audience, the same world, and the same intellectual property for years after the launch celebration is over. Before we calculate what it costs, we need to separate three names that people often treat as if they mean the same thing. Grand Theft Auto is the intellectual property, the name, characters, fictional worlds, code, art, trademarks, and commercial rights attached to the franchise. Rockstar Games is the publishing label and creative organization associated with that franchise. It coordinates a network of development studios and publishes other major properties, including Red Dead Redemption, Max Payne, L.A. Noire, Bully, and Midnight Club. Take-Two Interactive is the publicly traded parent company. It owns Rockstar Games, operates 2K, and owns Zynga. Its shares trade on the Nasdaq under the symbol TTWO. This distinction changes the ownership question completely. You can buy one Take-Two share and technically become a very small owner of the company. You receive no office at Rockstar, no power over the launch date, and no ability to change a mission in GTA 6. You simply own a microscopic economic interest and a vote that is too small to control anything by itself. To control the company, you need enough voting power to determine the board, approve major decisions, and direct the corporate strategy. In practice, that means negotiating an acquisition of Take-Two or assembling a controlling position under securities rules while the market reacts to every share you attempt to buy. And Rockstar is not an empty shell holding a logo. Take-Two describes it as a label that deliberately develops a limited number of titles designed for quality and longevity. The model is not to release 10 disposable games every year. The model is to create a small number of cultural events, build franchises around them, and then extend their financial lives through sequels, virtual currency, add-on content, memberships, and in-game purchases. That is why the time between major Rockstar releases can look almost absurd from the outside. Grand Theft Auto 5 launched in 2013. GTA 6 is scheduled for November 19, 2026. More than 13 years separate the two numbered releases. In most consumer businesses, disappearing for 13 years would destroy the brand. In this business, the previous product continued selling while the next one was being built. As of March 2026, Take-Two reported that the Grand Theft Auto series had sold more than 465 million units. GTA 5 alone had sold more than 225 million. That makes the old game more than a successful product. It is a bridge that has carried the company from one hardware generation to the next, from physical discs toward digital distribution, and from one-time game sales toward recurring spending. When you buy the company behind GTA 6, that installed audience is one of the assets you are buying. But it comes attached to a price. On July 14, 2026, Take-Two shares closed at about $237. At roughly that level, the stock market valued the company at close to $44 billion. That does not mean you could write a $44 billion check and take the keys. The quoted market value is the price of all shares at the current trading price. The moment you announce that you want the whole company, the situation changes. Shareholders know you need their approval. The board has a duty to evaluate the offer. Other buyers may appear. Employees worry about their jobs. Regulators examine the transaction. And investors demand a premium because they are surrendering the future upside they believe GTA may 6 create. Let us build a hypothetical acquisition. Start with a market capitalization of approximately $44 billion. Offer a 30% takeover premium, a normal conceptual starting point for a large strategic acquisition, though a real premium could be lower or much higher. Your equity purchase price is now roughly $57 billion. Then consider the balance sheet. At the end of March 2026, Take-Two carried about $2.5 billion of long-term debt, plus a small amount of short-term convertible debt. It also held more than $1.5 billion across cash, cash equivalents, and short-term investments. After a simple debt and cash adjustment, your hypothetical transaction approaches $58 billion before legal fees, financing fees, retention packages, integration expenses, and the possibility that shareholders demand an even larger offer. $58 billion to own the company behind an $80 game. That comparison sounds ridiculous until you understand that the game is not what you are purchasing. You are purchasing an intellectual property portfolio, a global development organization, distribution agreements, player accounts, proprietary technology, online economies, and the ability to release new products under brands that already have worldwide demand. You are also buying 2K and Zynga whether you wanted them or not. If your original dream was simply to own Rockstar, the corporate structure forces you to become the owner of mobile puzzle games, annual sports titles, advertising systems, customer support operations, and thousands of employees who may never work on Grand Theft Auto. That diversification is useful because it reduces dependence on one launch. But it also makes your acquisition much larger and more complicated than the fantasy. And finding $58 billion is only the first obstacle. If you finance a large portion with debt, the interest bill changes the economics immediately. A $30 billion loan at 6% costs $1.8 billion per year in interest before you repay $1 of principal. Take-Two generated $6.66 billion of revenue in fiscal 2026, but revenue is not cash available to pay an owner. That same year, the company reported a net loss of about $298 million. The company can be enormously valuable while still reporting a loss. That is what happens when investors are pricing not only the money being earned today, but the catalog, the pipeline, and the profits they expect tomorrow. A car company owns assembly lines. An airline owns or leases aircraft. A hotel owner can point to rooms, elevators, and land. The company behind GTA 6 owns offices and equipment, but its real factory walks out of the building every evening. At the end of March 2026, Take-Two reported 12,909 full-time employees. Nearly 10,000 of them were focused on product development. Those numbers cover the entire Take-Two organization, not Rockstar alone, because the company does not publicly break out a precise GTA 6 headcount. That distinction matters. Internet discussions frequently attach enormous budgets and employee estimates to GTA 6 as if they were confirmed facts. Take-Two has not publicly disclosed a complete GTA 6 development budget. A serious ownership analysis cannot take a viral estimate and turn it into an audited number. What the company does disclose is still revealing. In fiscal 2026, Take-Two recorded about $1.07 billion of research and development expense. It also ended the year with roughly $2.15 billion in capitalized software development costs related to titles that had not yet been released. Again, that figure covers the company's unreleased pipeline, not GTA 6 alone. But it shows the scale of money sitting inside products that customers cannot yet buy. Game accounting creates a strange financial delay. Some development costs are expensed while work happens. Other qualifying costs are capitalized on the balance sheet and then recognized over time after the game is released. When a title finally goes on sale, part of the development investment begins flowing through cost of revenue as amortization. In ordinary language, money can leave the company years before the income statement fully reflects the cost of the product. And the company may carry a huge development asset whose value depends on a launch that has not happened yet. That is why delays hurt in more than one way. Every additional month means more salaries, more testing, more office costs, more technology, and more opportunity for competitors to capture player attention. It pushes revenue further into the future while much of the organization continues getting paid today. But releasing too early can be worse. A broken launch does not simply lose a week of sales. It can damage the brand, increase refunds, force expensive emergency work, weaken reviews, and reduce the number of players willing to enter the online ecosystem. Rockstar's entire strategy depends on quality and longevity. That makes patience an asset, but it also makes time one of the largest costs in the building. As of July 2026, GTA 6 is scheduled to launch on November 19, 2026, for PlayStation 5 and Xbox Series X and S. The announced standard price is $79.99, and the Ultimate Edition is $99.99. Pre-orders opened in June. Those prices create the first revenue layer, but the sticker price does not travel directly into your bank account. The consumer may pay $80. Sales taxes are collected. The platform and distribution channel take their contractual share. Refunds, promotions, foreign exchange movements, and regional pricing affect the result. Physical or code inbox distribution adds another chain of partners. The exact agreements with Sony and Microsoft are confidential, so any universal platform percentage used in a public calculation must be treated as an assumption rather than a disclosed GTA 6 fact. This platform dependency is enormous. Take-Two reported that its 5 largest customers represented more than 80% of fiscal 2026 revenue, with Apple, Sony, Google, and Microsoft each individually representing more than 10%. That figure includes Take-Two's entire business, especially mobile games, but it reveals the structure. The company may own the game, but it does not own most of the roads leading to the customer. Then comes marketing. Take-Two spent about $1.77 billion on selling and marketing in fiscal 2026. Most of that was not GTA 6 marketing. The number covers the entire group, including the expensive business of acquiring mobile players. Still, it proves that digital distribution does not eliminate the cost of demand. A game can be downloaded without a truck, but attention still has to be won, trailers produced, storefronts coordinated, press managed, customer service staffed, and launch infrastructure prepared. GTA 6 arrives with an advantage almost no new product can buy: anticipation. GTA 5 generated more than $1 billion in estimated worldwide retail sales during its first 3 days in 2013. 13 years later, the sequel does not need to explain what Grand Theft Auto is. But anticipation creates its own liability. The more people expect, the more expensive disappointment becomes. The first layer is full game sales. Every standard edition and every premium edition creates a large burst of revenue around launch. Console games normally generate a substantial portion of lifetime sales in the first months, which is why release timing can transform an entire financial year. The second layer is catalog sales. A new GTA release increases attention across the franchise. Some players buy older titles. Some return to GTA 5. Some join GTA Plus to access benefits and a library of Rockstar Games. The launch does not only sell the new product, it activates the shelf behind it. The third layer is recurrent consumer spending, virtual currency, add-on content, in-game purchases, memberships, and other spending that happens after the initial sale. This is where the economics stop looking like a traditional packaged game. In fiscal 2026, Take-Two generated $6.66 billion in net revenue. Approximately 78% came from recurrent consumer spending across the entire company. Full games and other revenue represented only about $1.46 billion. Digital channels delivered 97% of total revenue. Most of that recurring revenue did not come from GTA alone. Take-Two owns major mobile and sports businesses designed around continuous spending. But the company's financial structure tells you exactly what management values. A player who remains engaged can be more valuable than a customer who buys one box and disappears. Grand Theft Auto was already proving this before GTA 6 arrived. GTA products generated 12.4% of Take-Two's fiscal 2026 revenue. On $6.66 billion of total revenue, that works out to roughly $825 million from the franchise in a year with no new numbered GTA release. Think about what that means. A game released in 2013, together with its online ecosystem and related franchise products, was still helping generate hundreds of millions of dollars more than a decade later. GTA 5 had sold more than 225 million units, and GTA Online remained one of the company's largest revenue contributors. This is the financial template GTA 6 is expected to inherit. The launch sale pays you once. A successful online economy can pay you repeatedly. New vehicles, properties, missions, memberships, cosmetic items, and virtual currency can extend spending without asking the customer to buy an entirely new game every month. The challenge is balance. Monetize too little and you leave enormous revenue unused. Monetize too aggressively and players feel that the world was built around extraction rather than entertainment. The online business works only while enough people continue believing the experience is worth their time. The scarce resource is not the virtual currency. Your company can create that with code. The scarce resource is player attention. Now look at the other side of the machine. You have thousands of salaries and benefits. Offices in multiple countries. Servers and network infrastructure. Cybersecurity. Customer support. Quality assurance. Legal teams. Finance departments. Marketing groups. Data systems. Content moderation. Insurance. Platform compliance. Music and other licenses. Localization into multiple languages. Continuous updates for games that may remain active for years. Take-Two's fiscal 2026 numbers show the scale of the whole organization. Research and development expense was about $1.07 billion. Selling and marketing was about $1.77 billion. General and administrative expense was roughly $874 million. The company also carried about $2.5 billion of long-term debt. Not all of that belongs to Rockstar, and none of those totals should be presented as the GTA 6 budget. They are the cost structure you inherit when you buy Take-Two. The company also has an unusual internal cost, creative success itself. Talented developers, directors, engineers, artists, and writers are difficult to replace. When a franchise can create billions of dollars of value, retaining the people capable of maintaining its quality becomes a financial necessity. A factory can lose one engineer without forgetting how to manufacture every car. A creative studio can lose a small group of key people and discover that the culture, judgment, and institutional memory behind its best work cannot be replaced by simply hiring the same number of employees. Take-Two warns investors that losing key creative personnel could interrupt development and delay products. That is not generic legal language. In a business built around a limited number of giant hits, talent concentration becomes a form of operational risk. And then there is security. In September 2022, an unauthorized third-party accessed Rockstar systems and downloaded confidential information, including early footage from the next Grand Theft Auto. The direct financial costs were described as immaterial, but the event exposed the vulnerability of an asset made almost entirely from information. A rancher worries about drought. A mall owner worries about anchor tenants. The owner of Rockstar worries that years of unreleased work can escape through a network connection. GTA is one of Take-Two's greatest assets, and that makes it one of Take-Two's greatest risks. Grand Theft Auto products produced 12.4% of fiscal 2026 revenue. The company's 5 largest franchises together produced more than half of revenue. When a small group of properties matters that much, one delay, 1 week launch, or one major change in player behavior can move the entire company. GTA 6 has already demonstrated the timing risk. It was originally announced for 2025, later scheduled for May 2026, and is now scheduled for November 19, 2026. From a creative perspective, a delay may improve the product. From an owner's perspective, it moves revenue, changes marketing plans, extends development spending, and can cause the stock market to recalculate the company's value immediately. Then there is certification and ratings risk. Rockstar's major releases often target a mature rating. If a game received a more restrictive adults-only rating in the United States, platform holders might refuse certification and retailers might refuse to sell it. Other countries can demand changes or prevent a title from being sold without edits. There is also the risk of the online world itself. Fraud in virtual economies, outages, cheating, harassment, objectionable user-created content, privacy rules, and payment regulation can all turn continuing engagement into continuing compliance expense. And despite owning one of the strongest franchises in entertainment, you still depend on Sony and Microsoft for the announced console launch. You depend on payment systems, internet infrastructure, and regional storefronts. You depend on millions of customers having both the hardware and the willingness to pay. The game may look like a city where the player can go anywhere. The business sits inside a corridor of contracts. To understand why anyone would consider paying tens of billions for this company, look at what GTA 5 did after launch. In September 2013, the game surpassed $1 billion in estimated worldwide retail sales in 3 days. That would have been a historic result even if the product had then followed the normal pattern: a huge opening, several months of sales, discounts, and a gradual decline. Instead, GTA 5 moved across 3 console generations, reached PC, continued receiving attention through GTA Online, and sold more than 225 million units by early 2026. The original transaction happened once. The relationship did not. New players kept entering. Existing players returned for updates. Online spending created revenue between major boxed releases. GTA Plus added a membership layer. The catalog remained commercially active while Rockstar spent years building the sequel. That is why the 13-year development gap did not create 13 years without GTA revenue. The previous world financed the wait for the next world. And that is the real case for ownership. You are not paying $58 billion because GTA 6 could sell $80 copies. You are paying for the possibility that GTA 6 becomes another platform-like asset with a commercial life far longer than an ordinary entertainment release. Now let us build a hypothetical scenario. These are not Take-Two forecasts, and the company has not disclosed a complete GTA 6 budget. The purpose is to understand the scale of the ownership equation. Assume you acquire Take-Two for an enterprise value of approximately $58 billion. GTA 6 launches at an average consumer price of $82 after mixing standard and premium editions. Suppose it sells 35 million units during the first 12 months. That creates about $2.87 billion in consumer spending on the full game. You do not keep all of it. For this model only, assume the publisher ultimately recognizes 70% after platform and distribution economics, regional pricing, promotions, and other channel effects. That produces roughly $2 billion of hypothetical publisher revenue from the base game. Now assume the new product, related online spending, memberships, and the lift to older catalog titles create another $600 million of publisher revenue during the same period. Total hypothetical GTA-related revenue reaches $2.6 billion. That is an extraordinary result. But compare it with what you paid. Revenue equal to $2.6 billion is only about 4.5% of a $58 billion acquisition price. And revenue is not profit. You still have platform economics, development cost amortization, marketing, salaries, infrastructure, support, corporate overhead, interest, and taxes. Even if the launch generated $1 billion of operating contribution in this simplified scenario, that would represent less than 2% of the acquisition price in the first year. This is why a buyer cannot justify the deal using launch day alone. The mathematics require years of continuing revenue, new Rockstar releases, 2K titles, Zynga's mobile business, and eventual appreciation in the value of the intellectual property. The game does not repay the acquisition. The ecosystem has to. In the optimistic year, GTA 6 launches on November 19th as scheduled. Reviews are exceptional. Servers remain stable. The game sells tens of millions of copies without immediately relying on heavy discounts. Players complete the story and remain inside the broader ecosystem. Future online content creates a new recurring spending base. GTA 5 and the Rockstar catalog receive another wave of demand. Take-Two's other divisions continue performing, so the company is not forced to use GTA 6 revenue to cover unexpected weakness everywhere else. The market begins valuing GTA 6 not as a single release, but as a decade-long commercial platform. Your $58 billion acquisition looks expensive, but the asset grows into the price. In the difficult year, the release moves again or launches with serious technical problems. The delay pushes revenue into another financial period while development and marketing expenses continue. Reviews are good but not extraordinary, and expectations were so high that good feels like failure. Online features arrive slowly, suffer outages, or struggle to persuade players to move away from the mature GTA Online economy they already understand. Sales are still enormous, but they fall below the assumptions embedded in the price you paid. The stock market value that helped justify your acquisition contracts. Debt interest continues arriving every quarter. Key employees leave after the production cycle. A security incident exposes unreleased content or customer information. Regulators or platform holders demand changes in a major market. The difference between these scenarios is not whether GTA 6 is popular. It can be one of the most popular games in the world and still disappoint an owner who paid a price based on perfection. That is the danger of buying a legendary asset. The quality may be rare, but the expectations are already included in the bill. So, where is the real value? First, intellectual property. Grand Theft Auto is a name that can generate demand before the customer has seen a review. That reduces one of the greatest risks in entertainment: nobody noticing the product. Second, distribution power. A Rockstar release receives premium attention from platforms, media, retailers, creators, and players around the world. Attention that a new studio would spend years trying to earn appears almost automatically. Third, the installed audience. Hundreds of millions of GTA units have already been sold. The company does not begin every launch with zero customers. Fourth, recurring engagement. GTA Online proved that the franchise can operate after the story ends. Memberships, virtual currency, updates, and continuing content convert a release into a service relationship. Fifth, scarcity. There are many game studios. There is only one owner of Grand Theft Auto. A competitor cannot legally make GTA 7, open another official GTA Online, or put the franchise name on a rival product. The supply of this asset is exactly one. And finally, optionality. The owner controls future sequels, remasters, ports, licensing, memberships, merchandise, and whatever new distribution model appears over the coming years. Not every option will be used, and aggressive exploitation can damage the brand. But the legal right to decide has enormous value. This explains the strange economics of owning the company behind GTA 6. You spend tens of billions to acquire a business that can lose money in a financial year. You inherit thousands of people whose work cannot be measured like an assembly line. You fund products for years before customers can buy them. You depend on platform companies that control access to the audience. And you accept that one delay can move billions of dollars of expected value across the calendar. But if the system works, the company does something very few businesses can do. It creates a digital world once, sells access at global scale, and then keeps that world commercially alive long after the original launch. Which means you were never really buying GTA 6. You were buying the team capable of building the next world, the legal right to control it, the audience waiting to enter it, and the economic system designed to keep that audience inside. The disc is the product. The franchise is the asset. And the time players spend in the world is the business.